Welcome to the Investor Pro course. You are now a part of an elite group of individuals with access to tons of valuable stock market secrets that the pros don't want you to know. You have the blueprint to making substantial, long-term growth capital and becoming a very wealthy person. I'd like to take this opportunity to congratulate you on taking your first step into the world of stock investing. Make sure and enjoy your way through the course, and don't try to overstimulate your brain in one sitting. I've designed this course to walk you through the necessary steps for understanding future chapters, so I recommend taking the course chapter by chapter and not skipping around. A little about me. I don't work for an investment firm. People working for an investment firm invest other people's money in exchange for a fixed salary and/or trade commissions. We'll talk more about investment firms later in this course, but what I'm going to teach you here is how to be an actual investor. That's what I do. I am an independent, long-term investor focused on income-based growth stocks. I have made tens of thousands of dollars through trading and holding stocks, and the coolest part is, I have done everything from my laptop and smartphone. You won't need any office building or personal assistant. You won't need an Ivy League degree or a trading license. All you need is access to the internet, a checking account, and the motivation to learn. I'm going to teach you how to understand the stock market in easy to understand terms. We'll go through tons of potential stock investments, learning how to understand all of the confusing information and terminology out there. I'll show you what to look for in a good investment, and we'll talk about the red flags for bad investments. I'm even going to take you through the process of building your first diversified stock portfolio. The market never sleeps, and there's lots of money to be made. So let's dive right in. Preface: don't get intimidated. Stock investing is business. That's what it is. When you're buying a stock, you're buying a piece of a business. We'll get deeper into this concept. However, the reason I wanted to explain this clearly first is so you don't get intimidated. There are tons of different types of investments we'll talk about. You're not expected to understand every type of investment. We'll be covering these to give you a macro view at the world of various business investments. I personally have seen tons of success from investing in the stock market, but I really do think it's important to note that other investment opportunities exist. Remember, as you're moving through the course, to not become intimidated. Being an investor is understanding the concepts, but not being a dictionary. You can always reference the course later or utilize what you've learned in the course to use search engines more effectively to find the answers you're looking for. Try to enjoy the learning time. You're not going to get in trouble for just sitting back and listening. In fact, I recommend it. Get a good cup of iced coffee, if you like that kind of thing, and just start listening. Some concepts will make sense and others may seem confusing. Throughout the course, I continue getting into deeper detail from concepts discussed early in the course. Overall, have fun with this. The stock market is one of the coolest places in the world once you understand what is really going on and how it works. So without further ado, let's go. Chapter 1: A World of Investments. I would not be doing my job if I didn't tell you about the many different investment strategies out there other than stock investing. In this section, we're going to briefly outline some investment types you may already be familiar with, and some you're not. I recommend investigating all sorts of different investment types and even putting your money into different vessels so you're getting the benefits from all across the board. The first potential investment we'll talk about is called a certificate of deposit. Certificates of deposit can also be called CDs. These are what a bank would call a secure investment, and they're right. First off, CDs are insured by the FDIC. The FDIC is the Federal Deposit Insurance Corporation. This means your money is insured by a government agency and is virtually safe. CDs are timed investments as well, so unlike putting money into a savings account and progressively getting paid until you decide to remove your money, a CD requires a commitment to a variable of time. As an example, if I invest in a 6-month fixed CD, the amount of money I invest will need to stay in the CD for the full 6 months until it reaches what the industry calls maturity. You can then remove your investment and the income that goes along with it, or reinvest into another CD. Different banks and credit unions will offer different CDs at different interest rates, so when looking at these, be sure to survey a few different bank ideas. Also, it's important to note that there are 2 different rates of investment that you can choose from: a fixed rate and a variable rate. A fixed rate is not going to change. When you commit to the rate of return, it will stay to that agreed upon rate. A variable rate, on the other hand, has the potential to increase or decrease after committing to the investment. A variable rate is risky. It arguably caused the crash of 2008, and I do not ever recommend taking a variable rate. Always take the fixed rate. Overall, if you're looking for a safe play that is much better than a savings account, I recommend investing in a CD. The return is nothing like the stock market, but it requires no attention to investment and is as secure as it gets in the investment world. This may be a good option for you. Bonds. One thing I hear about all the time from people I meet is that they've heard of bonds, but they have no idea what they are, so they ignore them. A bond is an interesting investment, and in many scenarios can be a very profitable method for investment. However, it is very important to understand bonds before investing in them. So what is a bond, and how do you invest in it? A bond is actually giving debt to a corporate or governmental organization and earning interest on the loan, which is paid by the corporation or governmental agency. Essentially, one of these organizations exchange bonds for debt from an investor at a fixed or variable rate, as explained in the Certificate of Deposit section. A bond is typically issued by companies and governments to finance projects and/or activities. Owners of bonds are considered debt holders or creditors of that issuer. Some are available in the publicly traded exchanges, and others are private. So let me break this down. If a company or government doesn't want to do a loan from a bank, they can issue bonds directly to investors and get a loan that way. The issuer of the bond, which is the company or government organization, issues a bond that contractually indicates the interest rate that will be paid to the investor. It also indicates the bond principal, which is the term used to describe the money loaned. Last, it will give a date the money must be repaid to the debt holder, which is referred as the maturity date. This interest rate is called the coupon, and this is really what you're looking at when trying to figure out what you're going to be making on your investment. However, it's important to note that there are other factors as well, such as whether or not it is fixed or a variable rate. As emphasized in our last example, if you're going to explore investments in bonds, which I do recommend in your path to achieving a well-diversified portfolio of assets, I highly recommend investing in fixed-rate coupons. The actual market price of a bond depends on a number of factors, including the credit quality of the issuer, the length of time until expiration, and the coupon rate compared to the general interest rate environment at the time. Bonds can be an excellent asset class to invest in. However, we will not be covering bond investing in this course, but definitely consider learning more about bonds in the future, as they can make great investments if correctly evaluated. However, I do consider bonds to be a more advanced investment and recommend first gaining a firm understanding of stock investing. Commodities. Commodities are raw materials such as gold, silver, copper, or a primary agricultural product that can be bought and sold, such as coffee, orange juice, and corn. Now, to invest in commodities, you could just stock up on tons of coffee beans and hold them until you find a buyer for all the coffee. However, a lot of us are not in the coffee business, don't have a place to store all of the coffee, and in reality, don't want to deal with buying and selling physical coffee. Trading commodities on an exchange is great because you're buying exposure to those classes without having to physically hold the commodities themselves. There are, however, a lot of commissions and taxes that are involved in trading commodities, which takes a lot of technical understandings of how commodity markets work. We will not be covering commodity investments in this course. However, I will encourage you to have an investment exposure to a precious metals, specifically gold and/or silver, as you grow and diversify your investment portfolio. Let's rewind the clock back to the early United States, trading gold for property and services, from land to food, water, or even a doctor's care. Today, we have introduced globally what we will refer to as a fiat currency. An example of a fiat currency is the greenback dollar we know and love so dearly. Fiat comes from the Latin term, it shall be. A fiat money is currency that a government has declared to be legal tender, but it is not backed by a physical commodity. Now, what does this all mean? Basically, gold and paper notes representing gold used to be the same thing. Today, they are not at all the same thing. Gold is a precious metal commodity still used to gauge world market values on a comparison scale. The greenback almighty dollar is essentially an IOU from the Federal Reserve Bank, a privatized bank that lends money to the United States of America. The Federal Reserve is often referred to as the Fed. Going back to the encouragement of having exposure to gold and or silver, the reason this is so important is specific to the world market's perspective. Unfortunately, because your almighty greenback dollars are nothing more than an IOU, they can in theory be worth nothing in times of crisis. Later in this program, we will discuss gaining exposure to gold and or silver and how to do it without paying massive commissions and taxes, with an end goal of being further diversified and backing our own dollars in our pursuit of a strong, long-term growth strategy. World market currencies. We will not focus too much on currency trading, but this is one of the more complex versions of investment. There are tons of different countries with various currencies. For example, the US dollar is a currency. The euro is another currency. Trading currencies is basically trading one currency for another, profiting from the variation in price of the two. Again, this is a more complex investment that we will not be covering in this course. But as an advanced method in the future, you could consider investing in various currencies, as you can make a killing if you know what you're doing. It's very interesting how often I hear questions about Bitcoin. So many people have been hearing that there are millions to be made in Bitcoin, and they ask me if they should invest in Bitcoin, and if so, how? Now, I'm not recommending you invest in Bitcoin. I do, however, think the investment has great potential at the time of writing this course. I need to stress that investing in Bitcoin is an example of a very risky investment, and that this is because it's completely unproven as a currency and investment platform. The interesting thing about Bitcoin is the potential value of that investment. Bitcoin has the capacity to increase to numbers that are excessively valuable, and that potential alone makes me personally very interested in this kind of investment. However, it's an investment that is more of a gamble than an actual investment strategy at this time. As an example, if the Bitcoin value were to be recognized as a world currency, the value of a Bitcoin today could skyrocket to valuations of 10,000% gain heights. At least this is what some well-known investors have predicted. Now again, I wouldn't suggest you dive right into Bitcoin, but as you're moving through this course, I recommend you utilize much of the same information for also researching the potential of Bitcoin. Henry Blodgett at the Business Insider magazine has made potential long-term predictions that Bitcoin has the potential to go as high as $1 million in Bitcoin valuation. As I'm writing this course, the valuation is around $250 a Bitcoin. If you're interested in learning more about Bitcoin and getting involved, I recommend checking out Coinbase. To purchase Bitcoins, you have to go through a broker like them, similar how you would purchase a stock. Real estate. Real estate is a very popular form of investment. There are different property classes such as residential and commercial, meaning personal or business real estate. There are also the different methods of investment, and the two main versions being buying and selling properties and renting to tenants. Tenants is an industry term used to refer to the renters of a given property. Buying and selling properties can be very attractive to new investors in particular. I've met a lot of people who have shared with me their dream of flipping houses. If you're not familiar with the term flipping houses, let me fill you in. Someone who flips houses typically looks for a property that is priced low and just needs a good facelift, fixes up the house on a given budget, and then resells the property quickly at a much higher price than purchased. Now, don't get me wrong, this works for a lot of people. But if you're interested in real estate, I would prefer you investigate renting to tenants instead. Someone who rents to tenants typically looks for a popularized rental property and looks to buy the property either all in cash or using someone else's money, such as a bank loan. The goal being, your monthly payments on the property to the bank are lower than the rent your tenant is paying you. After expenses and taxes, your monthly income is determined with the following formula. Total property passive income equals renter payment received minus bank payment due plus property expenses plus taxes. At the time of recording this course, banks are very hard to receive loans from, so it has made this form of investment a bit more challenging, especially to the new investor. This is likely to improve over time. However, it's good practice to visit a bank and ask about getting a real estate investment property loan. You'll typically be asked to put down a minimum of 20%. This means that 20% of the purchase price needs to be paid to the bank before they'll give you an additional investment capital. And for many new investors, that's a ton of money. So you may want to keep an eye on the real estate market by asking your bank frequently about investment property bank loan rates and requirements. But we will not be covering the details to real estate investing in this course. Businesses. Many of us have been approached by a friend, family member, or loved one who comes to us and says, "I'm going to open an amazing new restaurant," or "I've got the next big idea and I'm looking for investors." This is the epitome of small business investing. The catch being, there is typically little data on any proof that the business will be successful. These businesses are often referred to as startups. The process will typically follow as such. An entrepreneur will present you, the investor, with a business plan. You review the business plan consisting of a mission and vision statement for the company, the products and/or services it will provide, a potential marketing strategy, and lastly, the projected financials for startup capital usage and month-to-month expenses, projecting from startup to recouping the initial investment and operating expenses. The goal as an investor in a business is to analyze the entrepreneur as much as the business itself. When you look at Mike Markula, Apple Computer's initial investor, the story makes it very clear that he recognized not only a revolutionary product, but that the creator was someone special, and Markula's gut drove him to invest in not only Apple Computer, but in Steve Jobs as well. There are also businesses that are not physical storefronts, but instead virtual. What I mean by this are websites and application businesses. These can be great investments as well. However, be aware that you're investing in an entrepreneur as much as the business idea itself. And there is no regulation on a startup business plan, so take the financials with a grain of salt. The world is full of incredible investment opportunities, and I have covered some of the most popular forms of investing. However, this course is not about general investing. This course is about learning how to become rich through long-term growth investment strategy I have personally made tens of thousands from, and continue to grow my portfolio daily. Let me introduce you to stocks and how investing in them is going to change your Chapter 2. What is a stock and how do you invest in it? A share of stock is a piece of company ownership. If a company is in good financial standing, they can issue to the public something called common stock shares to raise capital for the company itself. I'll use the term capital frequently in this program. This is synonymous to the term money. Then, once the company is offered shares as a member of the public, you can actually purchase a piece of ownership in these companies. Once you do, you've officially invested in a stock, and you are now a shareholder of that company and have a claim on their assets and earnings. This comes with tons of privileges, but think of yourself as an owner of the company you bought. I do, and that's exactly what you are. Why would a company offer stock? Companies will offer stock for tons of reasons. Some reasons include wanting to gain investment capital to start a new business or grow their business, investing in research and development for new and/or existing products, paying for outstanding debts or large outstanding purchase orders, or even paying existing shareholders a dividend can all be considered good reasons. What is a dividend? Dividends are awesome. One of my favorite advantages to investing in the stock market is the potential for recurring passive income. A dividend is a distribution of a portion of a company's earnings to its shareholders. This distribution can be in the form of cash payments, shares of stock, or other property. We'll discuss details on dividends later in this program. But for now, just know that this is a great way to make money passively while investing for growth. Passive income. If you're not familiar with the term passive income, today is your day. Passive income is the goal. It is the end-all goal. Passive income is money received on a regular basis with little to no effort involved. Humor me for a minute and close your eyes. Imagine what you would need to make a year to make your life awesome. Really think about it here. Let's say 6 figures, for example. The goal becomes $8,500 in passive income a month. Now, what that goal means is that you would need to be making 6 figures a year without lifting a finger, just letting your money work for you. Stocks can be a great part of increasing your passive income, and as you have more successes in the market, you'll have the ability to continue investing in stocks with good dividends that will pay you just to hold the stock. Investing for growth versus day trading. Throughout this program, you'll hear me speak frequently about investing for growth. What I mean by this is that we will be looking for stocks that show solid financial fundamentals, and will plan to hold every investment for a 1-year period. There are many reasons for this 1-year period holding, but this will be explained in detail later in this program. A different form of investing in the stock market is called day trading. This is when investors concern themselves with the second-by-second movement of their stock investments. We will not be covering this form of investing in this course. But it is important to know the difference, as when money is on the line, it is easy to make decisions based on emotions rather than fundamentals and research. By the end of this program, I plan to teach you how to learn confidence in the ups and downs of the stock market and help you learn to see through the small changes and instead understand why this is happening and remain focused on the one-year calculated target. Trading on fundamentals, not fear. Being a great investor can at times be very similar to being a great skydiver. The key to remember is the training, research, and overall fundamentals. If a great skydiver let fear hold him back from jumping out of a plane, he wouldn't be anything more than a guy who rides in airplanes with the doors open. Being an investor is very similar. When hard-earned cash is on the line, it is easy to let emotions get the best of you. I'm here to tell you that if you do, you will be on a downhill slope to fear-based failure, and not just in the stock market, but likely in everything you do. We are going to reprogram your basic instincts. When we invest money, we're going to imagine that we spend it on something that doesn't generate income and it's gone for good. This will liberate your fear. You do have to commit to this, though. It is not something you can just say out loud. When you make an investment, I want you to truly believe that you will never see a penny of that investment again and be completely okay with that. A few reasons why. First, as a stock investor, your investments have the potential to go to zero. You should never leverage yourself so far that you have no escape if the market crashes. I had friends who invested in Bear Stearns in 2007. You may not be familiar with Bear Stearns, but it was a New York-based global investment bank and securities and tradings brokerage firm that completely failed as a result of the 2008 global financial crisis and recession. Bear Stearns hit its 10-year high on January 18, 2007. For some, it seemed like Bear Stearns would just keep climbing. Throughout the year, the stock declined to under $100 a share, which many people thought had huge upside potential. One day, I'm running on the treadmill watching CNBC Business News, and the word comes in that Bear Stearns is seemingly crashing. I kid you not, in the period of time it took me to finish my run, I watched the stock tank from $75 to next to nothing a share. JP Morgan ended up purchasing the company and its assets for $10 a share. Now, why am I sharing this story with you so early in the course? It's not meant at all to scare you away from investing in the stock market. Instead, it is to inform you and to strengthen your emotional core. Put yourself in some of my friends' shoes. Many of them sailed that ship into the ground and lost their entire investment. How would you feel? Defeated? Broken? Worthless? Dumb? Don't. Investing in the stock market is not easy, and there will surely be ups and downs throughout your trading career. But once you learn how to read the waves, you'll know how to surf them. In this course, we will focus heavily on training you before ever having to leverage a penny, preparing you to have a skin in the game. When you're ready to put real cash into the market, please don't invest money you cannot afford to lose. Nobody wants to lose, but it can be a reality, and I would not want you to be out of the game after one bad loss. You should be able to lose and still get back in over time. Until then, continue educating yourself, and I'll show you some tricks along the way for saving and growing your money to prepare for the real thing. A famous quote from Franklin D. Roosevelt that most of us know very well should give you comfort when you have doubts. The only thing we have to fear is fear itself. Assets versus liabilities. In this program, when we speak about assets and liabilities, we'll be adhering to Robert Kiyosaki's definitions. Kiyosaki is the author of the Rich Dad, Poor Dad series. If you haven't read Rich Dad, Poor Dad, it's very important to. To summarize his take, when we speak about an asset, we're referring to something that doesn't cost you money to hold on to, but rather increases your passive income. Let's take a new $30,000 car as an example. When you buy this new car from a dealership and drive it off the lot, your investment automatically depreciates, which means it loses value. If you sell it back to the dealership 1 minute later, you lost $2,500. In addition to the depreciation in value, you also are now making payments monthly for gas, oil changes, insurance, maintenance, and more. Now, this hasn't stopped people from buying cars. A car makes life easier. You can get places quickly, and that definitely has its advantages. However, from the rich dad's perspective, this would be considered a liability. Now, let's talk about something that does have the potential to generate income. A 3-bedroom, 2-bathroom, single-family home. Again, real estate investing is not something we will be covering in this course. However, for this example, we'll cover the concept briefly. The value of the building materials will likely depreciate, but the demand for your land and location could very well be something that increases over time. Although by banks, your home would be considered an asset, Kiyosaki would argue that it is not an asset because you are still paying monthly for property taxes, a potential mortgage, repairs, and more. This makes your investment no longer an asset, but instead a liability. The story would be different, however, if you take this same 3-bedroom, 2-bathroom home and you were to rent it out. If your income coming in is greater than your expenses month to month, you are now getting paid to hold the property. This gives you certainty over time. Holding your investment will not cost you, and you'll be able to freely sell the property if an improved property value shows itself. Now, you've got an asset. This same evaluation of property can be applied to stock investments. When looking for the right stocks, we will be evaluating so many different variables to each company. One item that we'll be looking closely at are dividends. Like I explained earlier, a dividend is a distribution of a portion of the company's earnings to its shareholders. This distribution can be in the form of cash payments, shares of stock, or other property. Dividends are one of the tricks that can really ensure high-quality, long-term investment. If a stock pays a dividend, they are actually paying you to hold each share of the stock. Like having a renter in your investment property, you are now getting paid to hold and still have the full potential for a capital gain when the time is right to sell. If you're not familiar with this term, a capital gain is a profit that results from a disposition of a capital assets, such as a stock, a bond, or real estate. Simply put, it's the income after the sale of an investment. Getting paid dividends to hold a stock for a long-term period increases its value as you can reinvest the dividends into more shares of stock, or you can collect passive income, which Robert Kiyosaki likes to call cash flow. We will continue to dig deeper into dividends and capital gains later in this program, but the important takeaway here is first, the big difference between an asset and a liability, and second, how your stocks can quickly turn into assets if you're able to collect a dividend from your investments while still targeting a capital gain end result. Chapter 3, Investment of Time. Putting in the time to understand an investment before just buying something on a whim is key in becoming a great investor. People who buy a stock randomly and cross their fingers, or buy something because their mom's friend who knows a lot about stocks has insider information that it's going to explode, are people we call speculators. Speculators is good for one thing: figuring out where to begin. I will frequently speculate to locate a potential company. The difference between an investor and a speculator is that once an investor locates a company, they do their research on the company. There is so much information available to the public, it is unbelievable. But it is up to the investor to know where to look, what to look for, and how to understand when the time is right to pull the trigger. If spending time learning how to read financial reports, listening to live streams of shareholder meetings, reviewing charts and company statistics and other business-based research does not appeal to you, that's okay, because it may down the line once you understand what you're reading. But if you're not interested in putting in the time to learn, I recommend that you instead consider having your money managed by an investment firm. Investment firm versus investors. Investment firms are business entities, both privately and publicly owned, that manage, sell, and market funds to the public. Typically, they will offer investors a variety of funds and investment services, which include portfolio management, record keeping, legal, accounting, and tax management services. This can be a great option for some people, and there is plenty of upside, such as not having to do any research, not having to pay attention to the stock market, and overall have the safe and sound feeling that your money is in good hands. Here is the downside. Investment firms are still business entities. What that means is that you are paying them for their research time, for their advice, for their management, for their accounting services, and more. Additionally, if they choose to invest you in a fund that is managed by someone else, you will be paying that fund manager a fee to do the research for that fund's stocks. So many of the times your bank investment advisor isn't even doing his own research, but just putting you in a fund you could have easily put yourself in. We'll discuss these mutual funds a bit later in this program, but what you need to know for now is being an independent, long-term growth investor requires a lot of research and current knowledge. As you learn how to look at a company, your ability to research will progressively increase, and you'll find that your perspective on the market is much more vast than you could have ever imagined. Learning the language. The research itself can be really fun, and many times you'll find yourself aware of current events, most of the population will never realize. I live for reading about companies. I find it addicting, fascinating, relaxing, and fun. But it is important to know that getting comfortable with the lingo you'll read and watch does take time. I remember reading a magazine called The Economist when I first became interested in investing, and my mission was to get through one article every day, understanding what the article meant both as an article as well as how it applied to the stock market itself. If you have not yet read The Economist, it's a fun magazine to start getting an idea of just how complex some of the investment language can be. Now it's time for a vocabulary building exercise. Number 1. First, pick an article and read through it, skipping the words you don't understand. 2. Once you've read through the article, I want you to go back through, copying and pasting the words you did not understand into a notepad on your computer. 3. Once you've gathered the words you don't understand, I want you to look up the definition of each one, making sure you understand the terms before moving on. 4. Write down next to the words in your notepad personal summaries of what you read. It's important here to not copy and paste definitions, but read the definitions and interpret them into words of your own. 5. Now go back to the original article and read through the article. When you get to the words you didn't understand, read the definition out loud, replacing the confusing word, and the article should make much more sense. I really urge you to challenge yourself. If you read through an article and the language was easy, try a few others until you find one that really gives you some words to research and begin growing your investor vocabulary. Another great resource for building your investment vocabulary is the CNBC television network. If you do pay for a cable or dish service, you can access the network both from your television as well as their website. I have included the link here, www.cnbc.com/live TV. With your cable or dish service, you can log into their site and watch anywhere. Being an investor does require an infinite dedication of time and due diligence. The more time you spend learning every day, keeping up with the latest vocabulary, trends, analyst reports, company financial statements, and more, can at times seem overwhelming. The key to using your time for research efficiently is following a large group of companies from afar and choosing roughly 10 companies that will become your leads for future investment. Remembering to focus your attention on your leads and not get caught up in the thousands of different companies can be hard at first, but it's important to focus your efforts and know your leads inside and out. Now, let's get into it. It's time to start learning how to look for your leads and pick winners. Chapter 4, Google Finance. In this section, we'll be going through your new best friend, Google Finance, showing you how it offers some excellent resources for evaluating investments. We'll also be covering how to use Google Finance for creating your own artificial or mock portfolio, as I'll refer to it. Our mock portfolio will be used to practice investing without risking a penny. Before beginning to build our mock portfolio, let's start by walking through the features of Google Finance. First, go to www.google.com/finance. We're going to see a few things right away. Let's talk about what we see, as it can feel overwhelming if you're not sure what you're looking at. Starting from the left side, you'll see the following. Markets. This is your landing page for Google Finance. We will be defining sectors as the categories for industries or markets that share common characteristics. As an example, Nike, the apparel company, can be classified in the retail sector. Another example is General Electric, which can be classified to the utility sector. We'll continue to discuss this in a later section. News. This is one source you can utilize to read some of the top stories regarding the general state of the market, politics, the economy, and more. You'll also have the option to filter the information between the overall market and a portfolio-related news feed, which will show relevant news to the stocks you've bought in your mock portfolio on Google Finance. Portfolios. This is where the magic happens. Here you'll be able to set up a mock portfolio and learn how to trade the market firsthand. We'll set this up shortly, but for now, let's go to the next item. Recent quotes. An option to have your Google Finance page keep a list of the different companies you research and have them in a quick list access on the side. Here for companies you're always checking out or investing in. Stock Screener. This is a cool tool to help evaluate companies. I'll show you how this works later, but no, it's another tool to help evaluate stocks. Google Domestic Trends. This is a special feature specific to Google. Google Domestic Trends track Google search traffic across specific sectors of the economy. Changes in the search volume of a given sector on Google.com may provide unique economic insight. You can access individual trend indexes by clicking on the left-hand navigation. The indexes are currently calculated only for U.S. search traffic. This is a search engine for trends, an awesome tool for finding the right time to both buy and sell, especially for long-term traders like us. Predicting long-term growth trends can be a very valuable investment if done right. Let's go on a quick tangent and check out one of my real-life examples of my strategy of trading ahead of a long-term trends. One of my monster trades was purchasing 200 shares of Netflix at $54 on January 13th, 2010, which comes out to about $11,000 cash. At that time, Netflix was still just something the kids were talking about. There was not a large library of content. Streaming speeds were still questionable. They did not create original content and, in general, were not yet a replacement for your cable service. Recognizing a product or company that is primed for success based on upcoming trends and advances in technology can be a great way to recognize a potential monster investment. It is important to discuss this now before later. Trading on speculated upcoming trends is not something I'm endorsing at all. What we're discussing here is specific to helping locate potential monsters that then require a lot of research and analysis before it's time to pull the trigger. To finish the example, 1 year later I sold the 200 shares at $211 on February 23, 2011, which comes to roughly $42,200. Subtract my $11,000 investment and I'm left off with a solid gain of $31,200. Calculating percent gain, percent loss. Now, the cash is awesome, don't get me wrong, but the key to being a good investor is your percent gain. And the great thing about figuring this out is it's a very simple formula. Price sold minus purchase price divided by purchase price. The result will be equal to a percentage. So, as an example, if the result was 0.041, this would be a 4.1% gain. The way I convert from decimal to percentage is move the decimal to the right 2 digits and then put a percent sign next to it. May seem juvenile, but it's quick and it works. So let's put my Netflix example into action. $211 minus $54 divided by $54 equals 2.907. Move the decimal point to the right 2 and we get 290.7%. Not bad for a year. Chapter 5, Setting Up Your Mock Portfolio. This next section is exciting. You should be proud you've made it this far through the course. The initial information can feel overwhelming, but now we have some foundation. We can put it into action and learn hands-on. I'm going to take you through the process of setting up your first mock portfolio to start learning how to evaluate stocks over periods of time without risking a penny. We'll be buying artificial shares and we'll treat our investments as real money. Let's take this as serious as the real thing. First, if you do not yet have a Google account, I'm amazed, but it's completely cool. They're free and easy to set up. I'll walk you through setting up a Google account to be thorough. However, if you already have a Google account, feel free to skip the next section. Registering a Google account. I included this section to be thorough. However, if you already have a Google account, feel free to skip this section. First, if you're still on Google Finance, navigate to the top right of the website and hit Sign In. If you're not on Google Finance, just go to google.com and hit the Sign In button on the top right of the website. Next, hit Create an Account below the provided sign-in window. Now here we'll enter our first and last name and choose a username. I personally would like to take a second here, as you may use your Google account frequently and you'll want to love your username. Many names are taken, so you may have to try a few times, but don't move on until you found one that you like that's available. No need to rush. Create and confirm a password for your account. Add your birthday and gender. Now you're asked to add a mobile phone number. You can click the displayed flag icon to change locations for international calling code assignment. Now, enter your email you use otherwise. Next, you'll need to verify you're not a robot. This is just referring to different programs that hackers can create to damage sites, so they protect themselves by confirming you're a real person interested in registering with Google. You can manually enter the displayed code, or you can opt in to receive a call with a code you'll need to enter. You'll be called right away, so make sure you're near your mobile number if you choose this option. Confirm your location from the drop-down menu here. And then lastly, confirm the terms and conditions and privacy policy by checking the box and hitting Next Step. You'll need to verify your Google account by checking your personal email and clicking the Verify link. Once verified, you have a Google account and have so many free tools at your fingertips. Although we'll be focusing on Google Finance in this course, I highly recommend checking out some of the amazing features of Google, including Google Drive, where Google gives you 15 terabytes of free cloud-based storage for documents, videos, photos, and more. You can also use the Google Drive to create live documents and work on a document at the same time as a colleague in real time. Google is truly an amazing service. You'll love being in the club. Enjoy. Google Finance Mock Portfolio. All right, now click Portfolios and let's do this. We're first going to make an artificial investment into our trading account from our artificial checking account. On the top here, you'll see the word Cash with Deposit and Withdraw next to them. We'll hit Deposit and set the date to today. I'll set mine to January 1st, 2016. Now it's time to add our investment budget. I'm going to set mine to $20,000, and I recommend you do the same to get some good practice in. However, you can always deposit more later. Just a reminder, this is not real money. This is an artificial investment platform designed to allow you to train on making real-time, logged investments before putting your own skin in the game. For notes, we'll put, I'm officially a stock investor, because you definitely are. This is where things get awesome. Hit Add to Portfolio and check out your cash. It's just waiting to be invested and grown into stacks and stacks of artificial cash. Let the games begin. Add symbol option. We're not going to be adding any stocks yet, or as it's labeled, add symbol. But let's try this out so you can see how it works for later. Let's go back to my previous example of Netflix. The language symbol is referring to something that can also be called a ticker, which is an abbreviated assembly of seemingly random letters representing each stock in the market. Now, you'll get to love the tickers and will memorize hundreds over time and won't think twice. But for now, it might seem hard. The great thing about Google Finance is they account for either the ticker symbol or the company name itself. So let's try typing in Netflix. The ticker symbol for Netflix is NFLX. As you can see, we're not done yet. The search results have given us a bunch of Netflix options. So how do we know which one to pick? On the right display, you will see some additional abbreviated letter sets. These abbreviations are representative of the stock exchanges the stock itself is traded on. In Netflix's case, it's traded in multiple exchanges. For our investments, we're going to stay in the major United States stock exchange markets. We will not be covering trading outside these markets. In this example, we can see the NASDAQ exchange, so we'd select this one. But like I mentioned earlier, we'll skip this for now and come back to actually pulling the trigger on some artificial shares later. We'll discuss adding transaction information later, Chapter 6, Equities, Securities, and Stock Exchanges. So we just discussed that in this course, we'll be focusing on the major United States stock exchanges. However, what is a stock exchange, and how do you know if it qualifies or not? New York Stock Exchange, also commonly abbreviated as NYSE, is a stock exchange based in New York City and is considered the largest equities-based exchange in the world, based on total market capitalization of its listed securities. Wow, that's a mouthful, right? It's actually pretty simple, but the average person we know would have no idea what that definition meant. So let's break it down for practice on how we would learn what this meant. Applying the vocabulary building exercise. First, we'd read through the paragraph. Second, we'd write down a list of terms or phrases that were unfamiliar to us. I'm going to write down equities-based exchange, total market capitalization, and listed securities. Next, we'll use our friend Google Search. Let's type in equities-based exchange into the search area. Let's start by defining equities-based exchange. As we discussed earlier, an equity investment generally refers to the buying and holding of shares of stock on a stock market by individuals and firms in anticipation of income from dividends and capital gains, as the value of the stock rises. So an equities-based exchange would be a place where shares of stocks are traded between individuals and firms in a marketplace fashion. Next, let's define market capitalization. Investopedia defines market capitalization as the total dollar market value of all of a company's outstanding shares. Last, let's research listed securities. Again, Investopedia defines securities as a financial instrument that represents an ownership position in a publicly traded corporation, stock, a creditor relationship with governmental body or a corporation, bond, or rights to ownership as represented by an option. Now that we understand the terms we didn't before, let's fill in the blanks with the definitions. The New York Stock Exchange, commonly abbreviated as NYSE, is a stock exchange based in New York City and is considered the largest equities-based or stock market for buying and holding shares of stock marketplace exchange in the world, based on total market capitalization or the total dollar market value of all of their company's outstanding shares of its listed securities or of the publicly traded ownership positions listed. Great. Now it's easier to understand what the New York Stock Exchange really is. Nasdaq Stock Exchange, Nasdaq. The NASDAQ stock market, commonly known as the Nasdaq, is an American stock exchange. It is the second largest exchange in the US and world by market capitalization and trading volume. The Nasdaq has been known for including growing tech companies and more, but is another great option for finding great long-term growth investments. Dow Jones Industrial Average, DJIA. Dow Jones Industrial Average is a price-weighted average of 30 significant stocks traded on the New York Stock Exchange and the Nasdaq. The DJIA was invented by Charles Dow back in 1896. Equities and securities. The terms securities and equities are used frequently when discussing investments. The terms are thrown around in many different contexts as well, but the key to understanding their terms and their contexts is understanding their meanings from a fundamental standpoint. A security is a tradable financial asset of any kind. Securities are broadly categorized into debt securities. Some examples of these are banknotes and bonds. Derivative securities are more complex concepts such as forwards, futures, options, and swaps. These will not be covered in this course. Equity securities, which are common stocks. When referring to securities in this course, we'll be referring to the equity securities. Equities or an equity is a stock or any other security representing an ownership interest. As an example, let's say your friend Joe Schmo started a lemonade stand business, and in order for him to open his new business for sale, he required a $1,000 investment for building materials, recipe inventory, advertising flyers, and labor costs. This investment would allow him to start the business and keep the doors open for 6 months to reaccumulate the investment and then grow the business. As an investor, I'd then evaluate your friend Joe Schmo's lemonade stand business plan, and if I recognize potential for success, I'd offer to invest in his business. In this example, let's keep it simple and offer cash for equity. What this means is, as an investor, I'm offering an investment of cash in exchange for a share of the company's ownership based on its current market value. This leads us to our next question. How do investors know what a company is worth? Let's dig into this next. Basic company valuation. There are two main types of valuation. Pre-money valuation, the valuation of the company prior to investment. Post-money valuation, the valuation of the company following the investment. Going back to Joe Schmo's lemonade stand business, let's break down the two differences in valuation. The value of the company prior to my investment would be known as the pre-money valuation. A post-money valuation would include my investment into the value of the company. These two numbers are important in small business valuations in particular. However, on a large-scale company evaluation, this is likely not helpful. So what are you looking for stock valuations? Because it is required by law for publicly traded companies to declare all information about the company to the public, there is a lot of information that needs to be evaluated before committing to a stock investment. Chapter 7. Choosing your sectors. What are sectors? Imagine you're in a grocery store and you're trying to find an orange. You'd locate the produce section, and there you would likely find a sign for oranges. Like the produce section of a grocery store, sectors are the stock market's way of organizing the thousands of publicly traded companies into their industry focuses. I have included a list of some of the major sectors that the market is divided into. This is a great place to start thinking about where you'll begin looking for your leads. Diversification. When you're speaking to friends and family about stocks, one thing you'll regularly hear is how good it is to be diversified in your investments, and honestly, I could not agree more. Where I disagree with the common consensus is how to diversify yourself. In this course, we will preach the sector diversification method. This means that each stock you hold will be based in a different sector. For example, Let's go back to the grocery store example. A diversified portfolio would have an apple from the produce section and Lucky Charms from the cereal section. An undiversified portfolio would have an egg from the dairy section and a gallon of milk from the dairy section, which prompts the popular phrase, "We don't want all of our eggs in one basket." Okay, maybe that was a stretch, but the point is this. The market's motion can be frequently based on sector news, trends, and more. The key is not overinvesting in particular sectors, so you can always be in the right place and not hoping one sector will skyrocket. The more popular understanding of diversification is owning a few shares of hundreds of stocks. I urge you to not take this route. The amount of research that is truly required to understand a stock makes owning even more than 10 stocks a full-time job. This course will teach you to pick winning leads in diversified sectors and make educated investment decisions instead of emotion-based trading. This leads us to mutual funds. Mutual funds are for the lazy investors. When you meet with a banker to invest your money, frequently they will want to move you into diversified mutual funds. Mutual funds can be a good choice for the person wanting to invest money, but who would rather pay others to do the work for them while still holding the risk of the investment. This can be a valid option for you if you're not looking to put in the time. However, I personally choose not to invest in mutual funds. In my opinion, they're for the lazy investor, and I'd rather take control of my investments and make decisions based on my research over another. I want to take a moment to play you a clip from Steve Jobs.
When you grow up, you tend to get told that the world is the way it is, and your life is just to live your life inside the world, try not to bash into the walls too much, try to have a nice family life, have fun, save a little money. But life, that's a very limited life. Life can be much broader once you discover one simple fact, and that is everything around you that you call life was made up by people that were no smarter than you. And you can change it. You can influence it. You can build your own things that other people can use. And the minute that you understand that you can poke life and actually something will, if you push in, something will pop out the other side, that you can change it, you can mold it. That's maybe the most important thing, is to shake off this erroneous notion that life is there and you're just going to live in it, versus embrace it, change it, improve it, make your mark upon it. I think that's very important. And however you learn that, once you learn it, you'll want to change life and make it better, because it's kind of messed up in a lot of ways. Once you learn that, you'll never be the same again.
This is a prolific idea he's pointing out for investors, inventors, entrepreneurs, artists, and more. Everything around you that you call life was made up by people that were no smarter than you. When you take the time to hear the founder of the current most valuable company in the world say indirectly that you can change the world, that you are just as smart as the investment banker that tells you where to invest your money, that you have just as much potential to invest your own money as a fund manager, does that mean you can change your world and in turn the world around you? This is your moment. Carpe diem. This program is about taking control of your hard-earned money and building wealth with it by your own terms and not trusting your money to someone else who claims they know something you don't. Publicly traded companies are required by law to disclose any important information to the general public and its shareholders. With the power of the internet at your fingertips, you can truly know everything that these men in cheap suits will claim to know about. Don't get me wrong, mutual funds can be profitable, but there are a lot of costs, including fund fees, that force people holding the fund to pay a management fee whether you make or lose money. Overall, it's your choice. You can trust someone else and hope to get rich, or you can trust yourself and learn how to become rich. What is the S&P 500? The Standard & Poor's 500 is an American stock market index based on the market capitalization of 500 large companies having common stock listed on the NYSE or NASDAQ. For many investors, the S&P is the bar. The goal for most investors is to beat the S&P 500 each year. Many investors are unable to beat the index. However, a great goal to set for yourself as we get into building our mock portfolios is to beat the S&P 500 in your annual growth. This can be a good indication that you're ready for the big leagues and can help you in deciding the correct time to move from the mock portfolio and put some skin in the game, which is slang for investing some real money into real stocks. I just finished ripping on mutual funds. However, for the individual who is looking to invest and does not want to manage their investments, my personal recommendation is investing in an index. An index, like the S&P 500, is a statistical measure of the changes in a portfolio of stocks representing a portion of the overall market. Now, anyone can start an index, and it is important to know that when considering an index. For the sake of good measure, the top 3 indexes are 1. The Dow Jones Industrial Average, or the DJIA. 2. The Standard & Poor's 500, or the S&P 500. 3. The Nasdaq Composite Index, or just the Nasdaq. Indexes were created because it would be very difficult to track every single security trading in the country, especially before computers had advanced to the point where they are today. The indexes were created to represent the market as a whole by taking smaller samples of the market and basically create averages to gauge the state of the markets in general. Now you can explore various index funds outside of the major 3. However, if you're looking for a straightforward investment, I'd personally recommend one of the big 3. This is for the investor, not interested in doing the research. However, in the future as you grow your portfolio, having exposure to an index is a great idea. Chapter 8. Sectors and Diversification. Like we've spoken about, a lot of investment bankers will stress the idea of your portfolio being diversified. Where some of these investment advisors may have unique techniques, the status quo for these guys is to invest your money into the funds that diversify between tons of different companies. They'd say that your exposure to a greater number of companies in the same and different sectors makes you less vulnerable to market dips. However, you're also less likely to experience strong gains when certain sectors do well. In this course, we're going to explore the concept of investing in a small number of stocks to be purchased and held, each stock being from a different sector. Before I continue explaining why, let me explain how the market works in general. The market as a whole moves up and down. These numbers are determined by the stocks within the markets, exchanges, indexes, and funds. According to market research, a high number of retail consumers show themselves routinely during the winter holiday season as Christmas shoppers in the United States. Although this is a trend for shopping, there are variables that can affect the delivery of market expectations. For example, say the consumer has been hit by the real estate problems of 2008. The market had to correct as the consumer did not have as much money to spend at the holiday time, and therefore many of the companies did not do as well as they had expected to. Understanding this example is important to understanding how the market works in general. Say for instance, I bought only kids' toy retailer companies such as Mattel, MAT, and didn't have exposure to any other sector because I was counting on Christmas season being successful as it always is. I would have had all of my eggs in one basket and would have been hit very hard when the estimates did not deliver as expected. Being diversified into different sectors is important for this reason. It was good to have exposure to the kids' toy sector if my research deemed it was a good place to be. However, I should have only had one stock exposed to that sector. This takes the risk away from betting on a specific market to do well and instead allows you to benefit from other markets that will do well instead as a result. Diversified portfolio exercise. I want you to pick 5 sectors that are of interest to you to be the first 5 sectors you research for your leads. Keep in mind that before pulling the trigger, which is slang for executing a stock trade, we'll want to confirm these sectors have a strong outlook for the 1-year investment projection. But for now, just choose 5 sectors that you know about and/or interest you. Here are some examples. Financial banking, such as Bank of America, BAC, US Bank, USB, and Wells Fargo, WF. Note, I will continue to use these stock examples throughout this course, and in no way are these examples meant to be recommendations, but solely examples for the purpose of education. Capital goods, clothing, drugs, energy, industrial goods, insurance, services, technology, utilities, agriculture, basic materials, semiconductors, chemicals, communications, construction, consumer goods, credit, electronics, entertainment and media, food and beverage, healthcare, information technology, IT, and software, Internet of Things, metals and mining, real estate, transportation, and many more. Once you've picked your sectors, let's go back to Google Finance and begin researching. Chapter 9, Finding Stocks Within Sectors. So you've chosen your sectors. Awesome. You should be getting pumped. You've found some interests of categories of companies that will be fun to learn about inside and out. Let's get to it. So for me, I'm going to be searching 1. Semiconductors, 2. Information technology, 3. Clothing, 4. Healthcare, 5. Media. So first, we need to be sure we completely understand how sectors are defined. I recommend starting by just typing the term into Google and seeing what comes up. Let's search semiconductors. A nice Wikipedia article comes up and defines semiconductors as the foundation of modern electronics. Semiconducting materials exist in 2 types, elemental materials and compound materials. Nice. So if we're interested in modern electronics like computers and such, this might be of interest to us. Take your time on researching various sectors. This can be fun, and you'll really start to appreciate how the world's marketplace somehow all works together to create, innovate, and distribute products and services to the consumer. After understanding your sector's definition better, now we'll take to researching each of your 5 sectors in more detail. I'll be using my examples from above, but feel free to follow along. I'll start by just typing in best semiconductor stocks into the Google search engine, and we'll see what comes up. There will likely be a few sources that stand out as credible. For example, when writing this course, I first see a Dividend.com article appear. This is one source of many that I personally trust to give me some insight. Another great resource can be the stock exchange sites, for example, Nasdaq.com. TheStreet.com, which is Jim Cramer of the show Mad Money on CNBC, who can be an awesome resource, and we'll talk more about him later. I also prefer CNBC Links, which I consider my most trusted source for honest, up-to-date information. Start digging into some articles, and you'll notice that almost all business resources will actually even hyperlink the stocks they're talking about within the article, and you can quickly check out what the stocks are about. Locate a couple of stocks from multiple articles that are being spoken about, whether positively or negatively being spoken about, and start making a list under our semiconductors of the stocks that stood out as interesting and are worth researching further. Repeat this process across your various sector selections until we have about 3 to 5 different interesting stocks for each one to research deeper into. Chapter 10. How to read a stock. Now that we've got our list of stocks, I'm going to show you how to perform what we will call a fundamental analysis, which is my way of classifying the act of reading through a chosen stock's information and getting an idea about the stock in general using the public information at hand. Let's start by performing your first fundamental analysis with a stock that's made a lot of money in the past, Netflix or NFLX. As I mentioned earlier in this course, I made a monster trade with Netflix, but just because we believe in a stock at one point does not mean it is always in a position to do well. For instance, I love Netflix both as a stock and as a service, but currently, as I'm recording this program, it is very expensive. It is important to know that although a stock can appear expensive per share, it can be undervalued. When I say expensive but undervalued, I'm referring to the price per share as expensive, meaning I can get fewer shares for my dollar. However, when a stock is undervalued, the potential for a rise in its stock price is almost a guarantee, pending the conditions of the general market as a whole. The same goes for inexpensive stocks. Even if you look at a stock and it's only $5 a share, could still mean the company is overvalued and not a good investment. As an example, as I'm recording this course, Sprint, ticker symbol S, is valued at about $5 a share. Now, we both likely know a lot about Sprint and have seen the stores on every corner. Our national inclination is to think, oh, Sprint is cheap, I'll buy that one, and then when it goes up, I'll make a ton. This is rarely the case. The stock valuations are based on many variables, and all stocks are not created equally. As we get more into evaluating stocks, this concept should begin to make more and more sense. So, let's go back to Google Finance by entering google.com/finance into your browser, and navigate to the top search bar on the Google Finance page. Here we'll search Netflix or NFLX. Remember, NFLX is what we call the ticker symbol and represents the company's stock as an abbreviation. If you type the full name Netflix instead of the ticker, you'll need to select the correct stock exchange, in this example being Nasdaq. Now, when we load the company stock profile, we're going to see a lot of numbers and charts, and it can look overwhelming, but it's not. Almost everything ties together in some way, and I'll show you how to read through this info fast and easily. We've already talked a lot about the ticker symbols and exchanges. which are listed on the top of the page here. But now let's talk about some of the other numbers and what each of these mean when evaluating a potential investment. Previous close. The stock markets open and close daily. There are some holidays the market is closed for, as well as weekends the market is closed. The previous close is simple really. It's yesterday's closing bell price point. Now the interesting thing here is the market really never sleeps, so you may see notes that indicate something called after hours trading, and this is the live price of the business being done after the closing bell, but will not be officially accounted for until the next day's opening bell. By the way, common terminology for the stock market opening and closing is the opening and closing bells. That being said, the previous close is really just a gauge for where the market ended yesterday and how it compares to where it opened today. Range, 1 day. When evaluating various stocks, you're going to see various range variables listed. One is the 1-day range. I rarely put much weight on this as we're targeting long-term investment growth. The 52-week range is representative of the entire last year's stock movements. This is a very important range to use when evaluating a stock for investment. Primarily, I use the 52-week range to compare the movements over the last year to the relevant news of those high-motion dates to really gauge what makes the particular company I'm evaluating move. This also can allow me to get a better, bigger picture of what their strengths and weaknesses not only as a company are, but specifically in the eyes of the market and shareholders. Average volume, 10 days. The average 10-day volume is the cumulative daily trading for the last 10 days. Now, this number can be specifically handy for determining if a lot of funds are picking up the stock. When large institutions make a stock purchase or sale, the volume of the trade is public knowledge, as large trades in and or out of a stock can gravely affect a stock regardless of fundamentals. So it is important to at least take a look at the average volume for at minimum the last 10 days, and you'll be able to get an idea if the large funds, or as I call them, the big dogs, are buying or not. The number is probably a bit confusing still, so let me tell you exactly what this is and how to view it. The average volume is the number of shares traded in a given period of time. The numbers can be very large as many funds are typically trading thousands of shares at a time. When the numbers are high, this can be a sign of the big dogs buying shares, which is a great sign that you're on the right track. The key is not to miss the move though, so definitely see if you may have missed the run or not. You can tell by how much the stock has moved within the given volume period you're evaluating. I think checking the 10-day volume is a great resource, but different volumes are available if you're interested. Open. The open is another way for saying the day's opening price. Sometimes this can be a helpful thing to glance at to get an idea of what happened in the after-hours markets, but I don't rest much weight in the actual open unless I'm actually about to execute a trade. In this case, I use the open price to help determine the price I will be executing the trade at that day. Next earning date. The next earning date is the next date the company will officially announce its quarterly earnings. A company's quarterly earnings are very important to understanding a stock, so frequently I'll wait for the company's quarterly earnings report to come out before knowing if I'm going to get into a stock or not. There are a few important things to be aware of when a company announces its earnings. Let's go back to Joe Schmo's lemonade stand example. If you were an investor in Joe's stand, you'd be interested as an investor in hearing what the business earned, wouldn't you? I would. Why invest otherwise? Essentially, that's what the earnings date is for. The company has responsibilities to its shareholders and government to report their earnings and will frequently host interviews with the CEO or an important company figure discussing what those numbers mean and the general state of the business, goals for the year, and more. It's a great opportunity for investors to get in and learn from the actual company themselves new developments on the horizon, why the stock did what it did, and what they think the stock should do in the future according to their plans, and a lot of great information in general. Shares outstanding, shares. The shares outstanding, sometimes just labeled shares, is exactly how it sounds. How many shares are in the marketplace? The official definition by Wikipedia is all the shares of a corporation or financial asset that have been authorized, issued, and purchased by investors and are held by them. They have rights and represent ownership in the corporation by the person that holds the shares. Market cap. The market cap is the total dollar market value of the shares outstanding of a publicly traded company. It is equal to the share price times the number of shares outstanding. This is an important number I love to look at. Just think of it as the total value of the company's public stock. When you multiply the current share price times the number of shares outstanding, it would be the total value of all the shares in the marketplace. This number can be useful when evaluating the difference in share prices. I want to explain this clearly, as I think many people often confuse the share price with the company's value. Just because a stock price is higher than another does not necessarily mean the company is worth more than another. The market cap is representative of how many shares they have at the actual share price versus the share price itself is specific to one share of stock. I'm going to pull an example from Investopedia, looking at the two companies, IBM and Microsoft, or MSFT. If we look at their valuations on February 15, 2013, stock prices were at $199.98 and $28.05 respectively. Although IBM's stock price was higher, we can see that Microsoft's market cap of $234.6 billion was actually larger than IBM's $225.1 billion. If we compared the two companies by solely looking at their stock prices, we would not be comparing their true values, which are affected by a number of outstanding shares each company has. The classification of companies into different caps also allows investors to gauge the growth versus risk potential. Historically, large caps have experienced slower growth with lower risk. Meanwhile, small caps have experienced higher growth potential, but with higher risk. Like I touched on earlier, this is really important to evaluating a stock correctly. The market cap is also frequently used to describe certain classes of stocks. There are 6 main variations of market cap classes that help you classify stocks into levels. The top level is called mega cap. This class includes companies that have a market cap of $200 billion and greater. These are the largest publicly traded companies. As an example, Exxon or XOM would be a stock in this class. Not many companies will fit into this category, and those that do are typically the leaders of their industries. Next down are called big large cap. These companies have a market cap between $10 billion to $200 billion. A majority of well-known companies find themselves within this class, including companies like Microsoft, MSFT, Walmart, WMT, General Electric, GE, and IBM. Large cap stocks are typically considered to be relatively stable and secure investments. Both mega and large cap stocks are often referred to as blue chips. The next level down are mid cap stocks. These are companies ranging from $2 billion to $10 billion. This class of companies is considered to be more volatile than the large cap and mega cap companies. Volatile is a word the industry tends to use to describe a stock that has an uncertainty of potentially taking a turn for the worst at any moment. Growth stocks are a major part of the mid-cap class. Some of these companies are likely not industry leaders, but they are well on their way. Continuing down the classes, we have small caps. Small caps are usually new and or young companies. Their market cap is between $300 million and $2 billion. Although their track records won't be as lengthy as those at the higher classes we've discussed, small caps often present the opportunity of large capital appreciation. This, of course, is offset with higher risk implications. Next are the microcaps. Consisting of mostly penny stocks, this category holds market capitalization between $50 million to $300 million. The potential for profits investing in these types of companies often reflects the downside potential. To invest in microcaps, a ton of research is necessary, and the level of public documentation is usually very sparse. Overall, these are not the safest investments, but you can make a lot of money if you know what you're doing. I recommend staying away. The lowest classification are the nanocaps. Companies have market caps below $50 million are nanocaps. Ultimately, the highest risk you can make in the public marketplace. Nanocaps, also often referred to as pink sheets, have almost non-existent regulation, causing false and or out-of-date information to be frequent. Nanocaps are traded on a stock exchange called the OTCBB, which stands for Over-the-Counter Bulletin Board. This exchange is regulated, but the level of regulation is much less than the higher classes described, and I highly recommend staying away from these as well. It is important to note that although we can classify certain companies under specific caps, these ranges are not permanent, and companies fluctuate depending on how the individual company, as well as the entire market as a whole, is performing, meaning stocks change market cap classes with the real-time marketplace. Once a microcap can become a small or mid-cap. Beta. Beta is a historical measure of the risk an investor is exposed to by holding a particular stock as compared to the market as a whole. So when looking at the beta, a 1 indicates that the security's price will move within the market. A beta of less than 1 means that the security will be less volatile than the market. A beta of greater than 1 indicates that the security's price will be more volatile than the market. Since it is a historical measure, this is not a number that can predict the future, but it can give us a great idea of how the stock will likely react in times of volatility in the market. Just to clarify, a word you'll hear a lot from the pros is volatile or volatility. Like I mentioned earlier in the course, this term is used to describe the amount of uncertainty or risk about the stock's value change potential. A higher volatility means that a stock's value can potentially be spread out over a larger range of values. Or in other words, a stock can make big changes in a short period of time in either direction. A lower volatility means the stock's value does not change dramatically, but instead moves at a steady pace over a period of time. Let me break this down for you. As an example, say Joe Schmo's lemonade stand has a 0.5 beta. In this example, we can use this number to determine that historically, Joe Schmo's lemonade stand is 50% less volatile than the market. That means that if the market moves up 10%, historically the stock should move up half the market move, which would only be about a 5% increase. On the other hand, if the market decreases 2%, the decrease would follow suit as well, with a 1% decrease historically. Overall, the beta can be a good number to glance at and get an idea of how the stock historically compares to the general market and can help you decipher company-specific changes versus general market changes. Dividend and dividend yield. Div yield. We already spoke about dividends earlier in this course. However, for evaluating a stock's dividend, it's important to understand what the numbers listed mean. First, let's talk about the difference between the terms dividend and dividend yield. As we spoke about earlier in this course, the dividend is a distribution of a portion of the company's earnings, decided by the board of directors to a class of its shareholders. Dividends can be issued as cash payments, as shares of stock, or other property. This is the actual distribution by the company. For example, say Coca-Cola, or KO, pays a dividend of $1 per share for every quarter, and you own 100 shares. Just for holding the stock, you're going to be paid a dividend of $100 every quarter, which of course equals $400 a year. There is no obligation outside of simply continuing to hold the stock, and this will be true. The only catch to this is that in times of success or distress, the company can change the amount of the dividend if need be. However, companies are typically very hesitant to do this unless absolutely necessary. The dividend yield, on the other hand, is a financial ratio that shows how much a company pays out in dividends each year relative to its share price. The formula for calculating the yield is annual dividends per share divided by price per share equals dividend yield. Ex-dividend date. The ex-dividend date is when a security no longer trades with its recently declared dividend. If you purchase a stock on its ex-dividend date or after, you will not receive the next dividend payment. Instead, the seller gets the dividend. There are 3 main dates to be aware of for dividends. 1. Declaration date, which is when the company's board of directors announce the issuance of a dividend to the shareholders. 2. Record date, which is where the company examines its books to see who its shareholders are to determine who will receive dividends. 3. Ex-dividend date is the second business date before the record date. So, as an example, if you wanted to purchase a share of stock on Monday, July 8th, and the stock's ex-dividend date is Thursday, July 11th, you'd still be eligible to collect the dividend. However, if you were purchasing on Friday, July 12th, you'd no longer be eligible. Dividend payable date. The dividend payable date is pretty self-explanatory. It's the date the dividend is payable to the shareholders from the company. This is one of my personal favorite days because I get paid for doing nothing but investing in companies. Volume. Vol. AVG. The average daily trading volume is the amount of individual shares that were traded in a day. To break it down, when the average daily trading volume is high, a stock can be easily traded and has high liquidity. As a result, average daily trading volume can have an effect on the price of the stock. If trading volume isn't very high, the security will tend to be less expensive because people are not as willing to buy it. INST-OWN. INST-OWN is the abbreviation for institutionally owned, which is how it sounds. It's an indication of how much of the company's stock is owned by the institution itself. As an example, a company could say own 50% of their public shares. The reason this number is important to consider because the institution itself has the most legal inside information there is. If a company holds their stock heavily, it can mean a lot of things, but one indication could be that they believe it is a strong buy right now. EPS. EPS is an abbreviation for earnings per share, which is the portion of the company's profit allocated to each outstanding share of common stock. Earnings per share indicates a company's profitability, so obviously this is an important number to evaluate. The formula for calculating the EPS of a stock is as follows. EPS equals net income times dividends on preferred stock divided by average outstanding shares. The net income can be found in the company's financial reports, which are available to the public and shareholders typically on the company's website under a menu called Investors or something close to that. Let's go back to our simple example of Joe Schmo's Lemonade Stand Company. If the earnings per share is a large number, we can conclude that the company is earning a lot of money per share. This can be good because it allows for them to use the earnings to invest in more growth through research and development, expand locations, increase production, or even reward its shareholders with an increased dividend, etc. On the contrary, if the earnings is a low number, this can be a red flag. Earnings are a very important number to consider. Look for high here. P/E. P/E is short for the price-to-earnings ratio. It can also be referred to as the price multiple, earnings multiple, or the PE ratio. The PE is a valuation of ratio of a company's current share price compared to its per-share earnings. The formula used to calculate this is market value per share divided by earnings per share. Let's say Netflix is currently trading at $414, and the earnings per share, or EPS, are $4.32 per share. The PE for the stock is $414.08 divided by $4.32 equals $95.85. So what does that mean? In general, a high PE means investors are anticipating higher growth in the future. Companies that do not have a PE ratio are losing money. PE is a great tool for comparing stocks within the same sector. As an example, let's take the companies Nike, NKE, and Under Armour, UA, and compare them using their PE. In this example, saying NKE is at 28.5 and UA is at 84.22. When comparing these two stocks in a given sector, such as in this example, retail, we would lean toward UA or Under Armour because the higher PE indicates investors are anticipating higher growth in the future. Some important notes for PE use. First, PE should not be used to evaluate stocks between different sectors. PE can be a great tool for comparing two stocks in a sector you like to help guide your decision between the two. However, it is one of many evaluation tools that make your final decision. Another thing to keep in mind when evaluating companies using their PE ratio is the average market PE ratio is about 20 to 25% times earnings. The charts. In addition to looking at the numbers, it's also important to review the charts and the correlating news around the charts to reference various movements through the various time frames. To be honest, I personally don't get too technical with the charts. Instead, I try to use common sense. I look at long-term perspectives primarily, but the charts are your friend and can help you understand moves in the market historically, and you can review the news and valuations historically as well to get a better idea of what you're looking at. Conclusion. At this point in the course, you have been filled with tons of vocabulary and conceptuals. It is important to absorb these concepts so that the application of these become relatively thoughtless. In the next section, I'm going to show you how to start making sense of all this information and begin to start finding the winners and applying all this information to help you determine if a stock is a buy and why. Chapter 11, Company Investor Relations. One of the most important parts of choosing a company to invest in is understanding the company itself and their business. All of their equation variables and charts are important, but there are a lot of details offered in the public financials that can give you the edge on everyone else who is not willing to take the time to read the statements. Publicly traded companies are required to share their financial information with the public. And what's great about this is it allows us to see true information about companies to get insights on what they're worth, what they are taking in after expenses, and what they're doing with their cash flow, or in other words, what they are doing with the money they make. Are they investing in cool new products that have a potential to make more money for the company in the future? Are they using the money to pay their shareholders bigger dividends? Are they increasing salaries to their employees in a new or particular division to grow part of their company in a specific location on the globe? There is so much you can understand about a company from learning about what they're doing with their cash flow. Let's take a look at the Investor Relations section on the Coca-Cola Company website by visiting www.coca-colacompany.com/investors as an example. There's a lot of stuff going on here, but don't get intimidated. Now keep in mind, websites change, so if you're completing this course and Coca-Cola has updated their investors webpage, the items may be located in slightly different locations. However, the documents we're talking about will be the same, and you should be able to find them by looking in the sitemap or exploring the page a bit for the investor area. There are a few different items worth understanding. Annual reports. The annual reports are where you will really see the company's money went over the last year. This can help to predict future profits based on their previous investments. We'll walk through reading an annual report shortly. However, just note that these are required to be filed by the companies annually and can be references for a lot of the years in the past. Quarterly earnings report. The quarterly earnings reports are huge. There are 4 quarters in a year. Companies are required to announce their quarterly earnings. Some companies will have quarterly web conferences, and others will only submit their reports. But regardless, the information is covering the quarter instead of the entire year. This is helpful in comparing the previous year's annual goals and direction with what's actually happening within the new year, quarter by quarter. Proxy statements. The proxy statement is required by the SEC, which stands for the Securities and Exchange Commission, for companies to outline matters that will be presented in an upcoming annual shareholders meeting. It's a good document to check out prior to the shareholders meeting so you can get a better idea of what the key topics will be discussed, both positively and negatively. Annual shareholders meeting. It's a must as a shareholder of a company to tune into the annual shareholders meeting. I personally recommend actually watching or listening live. However, if they do not offer a way to watch or listen, be sure to check out the transcript of the meeting. This is a great time for companies to really overview what the year has done and what they plan to do in the upcoming year. You'll hear about new products, places they're putting their focuses on, what they've learned over the last year, and how they'll proceed into the future to prosper. Overall, very important information, and it's usually pretty entertaining. Webcasts and conference calls. There are a lot of various opportunities for shareholders to watch, listen, or read about conferences the company is a part of. As an example, perhaps the company is announcing a new product in Brazil and are hosting a meeting announcing it. Separate from the quarterly or annual conferences, this is relevant information too. I always recommend checking out the websites of the companies that you're a shareholder of and monitoring upcoming webcasts, conferences, and general events. You can typically check out old events as well, which is good for getting to know a company in particular. In general, the more information you have, the greater the edge on the rest of the market you have. General Investors Area Overview. First, let's talk about the financial reports. I'll click the Financial Reports and Information tab here and go to the next page. This is something many amateur investors know very little about. The financials can look like a ton of numbers on paper. However, almost every large and complicated business can be exemplified by using small business examples. So let's go back to our Joe Schmo's lemonade stand example. If Joe Schmo expanded to offering 3 different types of lemonade, as an investor, you'll likely be interested in knowing which is the most popular product and if customers are buying the other flavors. The financial reports, in a simple sense, make these variables easy to understand. As an example, if I can see a lot of money going into developing new flavors of lemonade, but Joe Schmo's sells 90% regular and only 10% of other flavors, I may want to reconsider thinking the long-term growth strategy of Joe Schmo's. Instead of investing in new flavors, they could be investing in opening more lemonade stands, paying their investors dividends, or even just holding the cash and host focus groups on food items that complement lemonade the best and offer it to their customers. This is just a simple example of how to think of a large company like Coca-Cola. Look at Coca-Cola like Joe Schmo's. They have Coca-Cola, Diet Coke, Sprite, and so many more. They're located globally, and certain products perform better in different parts of the world. These are all important parts to Coca-Cola as a company and their success. I've known a lot of new traders to say things like, "Oh, Coca-Cola is such a great drink. Everybody drinks Coke. That stock is going up for sure." Unfortunately, it's just not that simple. Location popularity is definitely a factor, but there are so many more variables to consider that this kind of assumption falls into the category of speculation as we've spoken about through this course. So let's not be speculators, but instead learn how to read financial reports for some good information. As you progress in your understanding of investing, you'll continue to be able to explore deeper into the various financial reports, proxy statements, and more. For now, we're going to talk about some key numbers to look at in reports. Let's open up the Coca-Cola 2014 Annual Report. First, we see the title page. Let's scroll down to the table of contents. Some great items to check out are the following. 1. Forward-looking statements. 2. Selected financial data. 3. Management discussion and analysis on financial condition and results. 4. Quantitative and qualitative disclosures about market risk. 5. Financial statements and supplementary data. 6. Executive compensation. 7. Security ownership of certain beneficial owners and management and related. In general, within the financial statements and supplementary data section, you're going to find a lot of details on the numbers that represent the details on the company's state. Here you'll typically find the following information: consolidated statements of income, consolidated statements of comprehensive income, consolidated balance sheets, consolidated statements of cash flows, consolidated statements of share owners' equity, notes of consolidated financial statements, report of management, report of independent registered public accounting firm, and quarterly data. Understanding how to read and understand these statements requires time and practice. In this course, we'll cover the basics on what these different types of statements mean. However, this course will not cover the details in evaluating a company's financial statements beyond the understanding of general tips on what to look for in a winner. In future advanced courses, we'll cover the more advanced details on evaluating these different types of financial statements. However, in this course, I'm still going to cover details on the general concepts on what these types of statements are and what you're generally looking for in them. Income statements. Income statements are just that, statements of money earned by the company. Income statements break down the following: net operating revenue, or the total money taken into the company minus the cost of goods sold. This gives us the gross profit. Once we have our gross profit, we can subtract all the labor and general operating expenses to get our operating income. These are all important numbers to look at. The net operating revenues shows how much the company is taking in. But once you subtract the costs of goods sold, you're really able to see their profit margin. Profit margin is the term we use to describe the amount of revenue from the sales exceeds the cost in a business. Think of it like this. Joe Schmo sells a glass of lemonade for $1 a glass. However, it costs Joe Schmo 25 cents to make each glass of lemonade. Therefore, Joe Schmo's profit margin on each glass of lemonade is 75 cents a glass. When you're looking at this number in the income statement, it's called the gross profit. The difference in term here is specific to the totaled number by the company. In Coca-Cola's case, they're giving you the total profits after costs of goods for the entire year. So to make this clear, if Joe Schmo's lemonade stand sold 10,000 glasses of lemonade in a year, and it cost them 25 cents a glass to make, here's how we calculate it. 10,000 cups times 25 cents equals $2,500. This equals the cost of goods sold. Now let's figure out our net operating revenues. 10,000 times $1 equals $10,000. To calculate our gross profit, we just take the $10,000 net operating revenues and subtract the cost of the lemonade we sold. $10,000 minus $2,500, which equals $7,500 gross profit. The other item that is important to consider is the company's operating profit. This is the number that accounts for the actual operations of the business. Going back to Joe Schmo's lemonade stand, we incorporated the cost of the actual goods to create lemonade, but we didn't account for the person making and selling the lemonade at the stand. Let's say there are 2 stands with 2 employees. Their time at the stands calculates to about 10 cents a glass of lemonade. Using this information, let's calculate the operating profit. We'll take the 10,000 glasses sold and multiply them by 10 cents per glass. This gives us a labor expense of $1,000. Now, to calculate the operating income, we'll just take our gross profit of $7,500 and subtract our $1,000 labor costs to get $6,500 operating income. It's important to understand that with large companies, there are a lot more variables, as you can imagine, come into play. But the general concept here can give you a good idea of the state of the company and its general means of making money. When you're thinking about businesses, that can be one of the most important considerations. Are they making sales? Are their profit margins high? Are they using their labor effectively? Big questions that can truly help you to understand the company's revenue structure and overall shows a lot about the quality of the company. Balance sheets. The next important document for consideration is the balance sheet. The balance sheet is a statement of current assets as well as liabilities and equity for the company, or in other words, a statement of net worth. The purpose of the balance sheet is to show the income and expenses over the period of time accounted for. The general formula that companies use to calculate this is assets equals liabilities plus shareholders' equity. Going back to our earlier example of Joe Schmo's lemonade stands, let's step into Joe's shoes. To open the business, let's say Joe Schmo received a bank loan of $1,000. Because it's a loan, the $1,000 would be added to the liability side of the balance sheet. However, because the loan results in Joe receiving cash, the $1,000 cash would be added to the asset side of the balance sheet. Before I continue further, I have to make something clear that can be a bit confusing. The way the banks view assets and the way we have discussed assets in this course are two different definitions. A bank sees an asset as something that benefits the business and has resale value. As an example, a new tractor for a corn farmer would be considered an asset in the bank's eyes. In this course, we have observed Robert Kiyosaki's definition of an asset, which is something that earns more money than it costs. Going back to our tractor example, this would not be an asset in the eyes of Robert Kiyosaki's asset definition. Instead, this would be considered a liability, because it depreciates in value and requires fuel and labor to utilize. Try not to let these two different definitions confuse you, but just remember that the bank's understanding of an asset is very different than Robert Kiyosaki's definition. Now let's say Joe Schmo invests in his beautiful lemonade stand for his storefront. This stand costs $200 to design and create. Joe Schmo would add the $200 lemonade stand to his assets and remove $200 from his cash on the assets side. The assets and liabilities still balance. This is how the balance sheet works. Now, as Joe Schmo sells lemonade at his new lemonade stand, the cash he takes in is recorded as retained earnings to the equity. The profits from his sales are recorded to his assets side as cash. Retained earnings refers to the cash that stays in the company and is not paid out as dividends, etc. When looking at a company's balance sheet, you are looking for strong assets and low liabilities. It's also good to see how much of the earnings are retained versus being distributed through dividends. It's good to have a high dividend-paying company as your investment, but it's also important that the company is retaining earnings to continue growing as a whole. If they're not retaining some of the earnings, they will likely need to seek out loans to invest in growth, which of course affects the liability side of the balance sheet. There is a multitude of company documents that can be helpful when considering a company's investment potential. However, understanding these advanced documents will be covered in a future advanced course. Chapter 12, Finding Winners. I'm impressed. You've really killed it through this course so far. As you can tell by now, there's a ton of opportunities to become extremely wealthy when you have a clear understanding of the market and the different variables that make it up. It's important to continue reviewing the many different variables and getting more comfortable with looking at the numbers quickly and knowing what they mean. This will help continue to develop over time. However, don't be afraid to remind yourself what a number means or the formula used to generate the variable. You'll continue improving the process through repetition. By getting through the course this far, you've now earned the tools to be able to realistically evaluate, in general, what is happening in the market and how to look at stocks and find contenders for investment. What you have not done yet is learned how to pick the winners and then pull the trigger on your investment and get into the game. So let's break down what we know so far. Number 1. Investment types. There are many types of investments other than stocks. 2. Stock market. Home to all of your stocks, exchanges, and more. 3. Stocks. Companies the public can buy and sell ownership in. 4. Sectors. Categories for companies divided by their industry, what they do. 5. Fundamental analysis. Reading a company's summarized public information. 6. Charts and financial reports. In-depth research on a company's detailed information. Now it's time to put all of this information into action by 7. Running the numbers, where we'll compare and contrast stocks. 8. And grab our winners to execute trades in our mock portfolio. 9. Last, we'll choose the first stock we want to buy for real and make it happen. Running a fundamental analysis on your sector choices. Taking your list of 35 stocks within each of your 5 chosen sectors, it's time to perform your fundamental analysis. A good starting point can be looking at the P/E ratio between various stocks within their sector. This is where understanding the definitions is important, and as you grow more and more comfortable with the definitions, you'll be able to perform these analyses just by looking, within a few minutes. For now, start by looking at all the numbers and use our definitions we've covered within this course, starting with one of your 5 chosen sectors to see how the stocks compare to each other. Using this information, to the best of your abilities, make a choice between the stocks per sector and write them onto your leads list for later. These are going to be our starting place for your mock portfolio. Once we have our 5 diversified winners, it's time to build our mock portfolio. Chapter 13, Let's Practice Buying. Mock Portfolio. Awesome! You made it to the fun part. There are a lot of variables to understand before we can make an educated decision on a stock to really invest in it. Like we spoke about in the beginning, you can absolutely speculate on stocks and make money. You can. I've done it. You can also hire someone to speculate or research the answers for you. But with the knowledge you have gained in this course so far, you know you have the know-how to look within an attractive sector, perform a fundamental analysis on various stocks within the sector to find the best stock to purchase, and now it's time to pull the trigger, but without having to risk a penny of real money. Instead, we'll practice using pretend money. Important mock portfolio considerations. Setting up a mock portfolio can be frustrating to some, so let me fill you in on the warnings I have for you before you get started so you don't fall into the regret trap. First, when you make fake money in the stock market, that does not mean you should have invested real money. You didn't miss out on the gain, you gained experience and knowledge. You need this experience before getting involved in the real money market. Second, take the fake losses seriously. The purpose of starting a mock portfolio is not just to buy one thing with all of your money and hope that you make money. The ultimate objective is to provide you with risk-free experience. Like we spoke about, it's important to treat your initial fake money investment as seriously as real money. Once it's gone, it's gone. In the real world, that can take you completely out of the game, or worse. Third, don't be afraid to know when it's time to move from the mock portfolio to the real money portfolio. There is no rush to make the move to the real money market. However, after gaining experience on your mock portfolio and having some long-term success stories, don't be afraid to try making it real. You don't have to start big, but having real money in the game is an important conclusion on your path to becoming a successful investor. I have had many friends who have asked me for advice on investing in the stock market throughout my time as an investor. And the most difficult thing to see is the ready investor become too afraid of the real money investment. You don't have to make money on your first trade. It's not going to kill you if you lose a bit your first real time, because it's a valuable experience and it's likely you'll take a loss on something at some point. As I've preached throughout this course, don't be afraid when you're ready to make the move into the real thing and make your investor title official. Adding to your mock portfolio. So now we have our 5 winners here. Let's put them into our portfolio and start evaluating them. First, go back to google.com/finance. Now, if you have not yet already, let's hit Create New Portfolio on the top right of the Google Finance screen. Give the portfolio a name and hit OK. Now, if you did not earlier, let's make a deposit. I'm going to start with $20,000, but you can choose any number. Just remember, this is artificial and not meant to represent your actual budget, but instead allow you to experience the market by investing in multiple shares of multiple companies right away. Click the deposit button next to cash on your portfolio and enter today's date, the amount of cash you want to deposit onto your mock investment portfolio, and add the note, First Investment. Click the Add to Portfolio button on the right of the entry areas, and we're good. Once you've completed our deposit into the mock investment portfolio, it's time to pull out our list of 5 winners and start entering them into our portfolio. Now, my initial deposit was $20,000. Since we're buying 5 stocks, I'm going to divide my available investment cash by 5, which means $4,000 per stock. This will help me to determine how many shares of each of my 5 winners I can commit to. I'm going to pick a few random stocks. Don't take these stocks as a recommendation, as they are only being used for the purpose of example and are not a recommendation for real investment. My first stock will be PepsiCo, ticker symbol PEP. When I type the symbol into the entry area, Google Finance automatically detects the stock and the exchange. Make sure you're selecting the correct stock here. In this example, we see NYSE for New York Stock Exchange and PEP for PepsiCo. Now hit the Add Transaction Data plus button here and enter the following information. First, we'll choose the type of investment we want to make. There are 4 different order types: buy, sell short, and buy to cover. Buying is what we'll be primarily using. To buy is to convert cash into shares of stock for a price. Selling is also what we'll be doing once we're ready to cash in on our investment. Selling shares is converting your shares of stock into the market value at the moment of trade. Selling short is a method of trading where the purchasing party is betting the chosen stock will decline in value. The way this works is basically a person is selling stock they don't actually own. Then when the price of the stock becomes less valuable, they buy the shares they owned on credit at a decrease in value and make their profit based on the decline in price. This is a common method used by big firms and hedge funds. The concept can be extremely profitable. However, it can also ruin you. When a stock goes from $100 to $0, the stock cannot lose any more than you invested. However, if you are short selling or shorting a stock, the investment has an unlimited upside, which as a result gives short sellers unlimited downside. Buying to cover is a buy order that closes a short position. Basically, it's the equivalent of selling shares of stock you own, but instead for shares of a stock you short sold. As you can likely guess, we'll be selecting buy for our purchase. I'll repeat this process for my 4 other stocks, and just like that, we're investors in the stock market. Although we have no money on the line, it does not discount the level of research you performed and the action you've taken by assembling this mock portfolio. Treat the money like it's real and get ready to learn through the power of experimentation. If you need to deposit more money, don't worry about it. Just remember that was money you could have lost in the real world if you didn't take the time to really learn and understand. If you make tons of money, feel proud, but don't regret not investing real money. Your ability to learn and practice will result in long-term results, and it's worth taking the time to truly understand the market prior to investing real money. Throughout the process of learning through the mock portfolio, I recommend keeping a leads list of stocks that performed well, that you were able to understand and predict well, and overall feel confident with. Keeping a leads list can be very beneficial when looking to put real money into the market. It gives you an idea of where to start looking and can offer a level of security if you understand the company well. When I say understand a company, what I'm referring to here is how the company overall works. Things like spending a lot of money on research and development, which is frequently called R&D, can cause dips. But if you're able to recognize that the cash for investment in R&D typically has resulted in new valuable products that increase the company's sales and value, perhaps you can predict this company well during their R&D dips and find an opportunity to make a lot of routine income, pending their success of developments obviously. Congratulations, you've made it to the point where the true learning occurs. All of the technical understanding, general stock research, and terminology are extremely important to understand, but the learning about the actual stock market comes into play by choosing stocks, investing in them, following their every move, reading news on them and others in their sectors, and allowing the world markets and stocks to become a part of your life. Chapter 14. Learning by watching television. One of my favorite things about the stock market is how applicable the knowledge of the market is to the news of the world. What I mean by this is so much of the world's news that you'll hear reports on are frequently based on shifts in the world's money markets. If you have access to cable or a satellite network television, I highly recommend changing your television watching routine to incorporate a heavy volume of CNBC. When first getting started, the key to becoming comfortable with the ups and downs of the market is watching it move up and down every day. Knowing it's normal is half the battle. Some days the market is down and some days the market is up. You cannot let emotions get in the way of good research. This being said, another huge asset to watching CNBC in heavy doses is learning the investment language through repetition. Just like our exercise earlier in the program, where we performed research on the Economist article, listening to investors, analysts, CEOs, activists, politicians, and more really helps in gaining familiarity with the marketplace and overall the real-time happenings of the market. Learning what to look for, what to listen for, when to buy, when to sell, and more. One of my highest recommendations is watching a ton of CNBC and learn to love it. Chapter 15. Not ready for the real thing yet? This course is in no way trying to pressure you to dive right into the game. I practiced trading for 3 entire years before investing real money into the market. Practicing can be really fun and rewarding. If you are not ready to pull the trigger or are saving up to still get in the game, I'd recommend looking into another great mock portfolio experience on Investopedia.com called the Stock Simulator. You can really easily sign up by clicking on the top right on Investopedia.com and do the simple email sign up. Once completed, it's going to prompt you to sign up for various newsletters and sponsorships. Some of the newsletters can be helpful, but I'm not going to tell you to subscribe to anything you don't want to. They send a lot of mail typically, however, there can be a lot of good reading material that can help you along your way. Once you get logged in, you can play against other people in micro contests, investing a fixed amount of money for a given amount of time. This is really fun, and you can actually win money if you win. This can be another fun way of getting investing experience while not risking a penny. Chapter 16. Opening a free trading account. Guess what? It's game time. That's right, you heard me. It's game time now. Now that you've proven your abilities through mock portfolio purchases, it's time to take the leap and open a real brokerage account. For this, you're going to need some important information. 1. Personal information including date of birth. 2. A residential address. 3. Employer name and address. If you're not employed, this can affect your ability to qualify, as they use it to verify your identity. I recommend contacting the financial company and ask what the best option is. 4. Your checking account number and routing number. 5. Your social security number. Go to eTrade.com and hit the button on the top right that says Open an Account. Now, you're going to go through the personal information sections, adding in the information it prompts you for. These trading platforms are some of the most secure sites on the internet. I've been using eTrade personally for years and have had great experiences with it. They give perks to investors like free, commercial-free CNBC broadcasts and more. Plus, the level of information available in eTrade is amazing. You really get an edge on the competition just by using their service. Once registered and into the platform, we'll briefly talk about the interface and how to use it. If you're using a different platform, things will appear differently, but a lot of the same features should be available. eTrade platform. Once your eTrade account is created and your bank account is linked, you'll need to make a deposit into your eTrade account from your bank account. If you're looking to get into investing $5,500 or less, a great option for you may be considering a Roth IRA investment portfolio. You're only able to add $5,500 to the account a year. However, the money traded in your Roth IRA is considered tax-free. This could be a great solution to a long-term investor looking to grow their wealth and avoid taxation. Otherwise, you can create a standard trading account and just be aware you'll be taxed for all trades. Now, go to the Accounts drop-down and select Move Money and select Quick Transfer. Here you can use your bank account on file to move cash into your eTrade account. Once the money is successfully transferred, you can make a trade. Again, under the Accounts drop-down menu, click Complete View to view your accounts and cash holdings. Now, click on your account to see the empty portfolio. Here, we can execute a trade. Chapter 17. Let's pull the trigger. Now, when you're comfortable on your knowledge through lots of mock portfolio practice, it's time to get into the game and start becoming rich. Go to the symbol area here on eTrade and enter in your ticker symbol of the stock you want to buy first and hit enter. Now to the right of the stock price, you'll see two buttons, Buy and Sell. Click Buy. Now the process of purchasing the stock is straightforward really, but there are still a few different types of purchase styles I'd like to cover with you. 1. Order type. 2. Quantity. 3. Symbol. 4. Price type. Quantity is how many shares of the stock you're wanting to purchase. Symbol is where you enter the ticker symbol. As you should remember, our earlier example was NFLX, being the symbol for Netflix. There are 7 main price types to choose from when making stock purchases or sales. Market, market on close, limit, stop on quote, stop limit on quote, trailing stop $sign, trailing stop %sign. When you select market as your price type, you're saying that you want to buy or sell immediately at the best price available. Because of the immediate execution guarantee, you are not guaranteed a price, but typically you'll pay a price near the posted amount. This option can be good for long-term growth investors because we're not trading changes in cents. Sometimes it's good to just buy and get it done. Market on close. When you select market on close as your price type, you're making a purchase order for the trade to execute as close to the market closing as possible. This is more for the day trader than the long-term investor, and I do not recommend using this option. We're trading for the long term, and even a few dollars should not dramatically affect our decision to trade a stock. Limit. A limit order sets a minimum and maximum price you're willing to buy or sell the stock for. This can be a cool way to get the price for the stock you'd like. A limit order is essentially picking the price you want to buy it for, and your trading service will wait to get the stock at the price for you. Here's the catch. If it doesn't go to that price, it could skip it altogether. When buying, you'll want to set the limit as the maximum you're willing to pay for the stock, and when selling, you'll want to set the minimum you're willing to take for the sale. We will not be covering stop limit, trailing stop, and trailing stop percentage in this course, as these are more advanced concepts and not necessary for the purpose of this course. Once you select your option, preview your order. When you're ready, click Confirm to pull the trigger. Now this next step is extremely important. Throw your arms in the air and say yes. That's right, you did it. You're now a true stock investor. You have control of your money and know information that a majority of the world's population have no idea about. It's incredible getting to this point because you really start to realize how ridiculous it is to let someone else do this for you. Seriously, there's no reason to let someone else control your life. I'm extremely happy for you. I truly am. The reason I assembled this course was to share information that I've been asked so many times by so many of my close friends and family. It's a way for me to let everyone in on the investor secrets that the pros don't want you to know. They want you to go work hard at your job and let them get paid for taking risks with your money. That's not fair. You have the right to know what you're investing in, and even better, not have to pay anyone for their speculation. Congratulations. I have more information to share with you on resources that can continue helping you grow as an investor. As an investor, the world is always changing, and it's important to keep up with the markets, news, and be reading and watching updated materials all the time. Chapter 18, Recommended Media Research Outlets. I've spent years searching through tons of literature, both in physical and digital articles, learning all I can about stocks and the world's marketplace. In this chapter, I'm going to share with you some of the hottest spots to finding great information that gives me an edge on other investors. Books and audiobooks. Outliers by Malcolm Gladwell. The 4-Hour Workweek, Timothy Ferriss. Rich Dad, Poor Dad, Robert Kiyosaki. Stay Mad for Life, Jim Cramer. Steve Jobs, Walter Isaacson. Winning, Jack Welch. Tribes, Seth Godin. The Art of the Deal, Donald Trump. The Intelligent Investor, Benjamin Graham. Think and Grow Rich, Napoleon Hill. The Alchemist, Paulo Coelho. Periodical magazines, The Economist, Wall Street Journal, Forbes, Fortune, Wired, Entrepreneur, Fast Company. Television shows, Mad Money, Shark Tank, Squawk on the Street, Closing Bell, American Greed. Movies, The Pursuit of Happiness, Wall Street, Boiler Room, Barbarians at the Gate. Wall Street 2, Money Never Sleeps. Chapter 19, United States Federal and State Taxation. One thing that is ironically very difficult to learn and find answers about without spending weeks searching through piles of government documents and protocols is stock investment taxation. I won't spend a lot of time on this section, but there are two main forms of tax that you'll be expected to file for on your stock trades: federal and state taxes. State versus federal. The way the Internal Revenue Service, or IRS, looks at investments from four main perspectives: 1. Short-term capital gain. 2. Long-term capital gain. 3. Gain in retirement account. 4. Capital lost. Short-term capital gains do not benefit from any special tax rate. They are taxed at the same rate as your ordinary income. For 2014, ordinary tax rates ranged from 10% to 39.6%, depending on your total taxable income. If you sell an asset you have held for 1 year or less, any profit you make is considered a short-term capital gain. The clock begins ticking from the day after you acquire the asset up to and including the day you sell it. This is a big part of why we take a long-term investment strategy. Long-term capital gains. If you can manage to hold your assets for longer than a year, you can benefit from a reduced tax rate on your profits. For 2014, the long-term capital gains tax rates were 0, 15, and 20% for most taxpayers. If your ordinary tax rate is already less than 15%, you could qualify for the 0% long-term capital gains rate. For high-income taxpayers, the capital gains rate could save as much as 19.6% off the ordinary income rate, just for holding the assets for a year. Again, you can see why we take investing for the long term so seriously. If you're a good investor and are able to make good long-term investment decisions, you can really maximize your exposure to taxation and can rotate investments progressively to create a constant vessel for both capital gains and passive dividend income. Gain in retirement account. One of the many benefits of IRAs and other retirement accounts is that you can defer paying taxes on any gains. Whether you generate a short-term or long-term gain in your IRA, you don't have to pay any tax at all until you take the money out of the account. The negative is that all contributions and earnings you withdraw from an IRA, even profits from long-term capital gains, are taxable as ordinary income. You gain the benefit of tax deferral, but lose the benefit of the long-term capital gains tax rate. Capital loss. If your investments end up losing money, rather than generating capital gains, you can use those losses to reduce your taxes. The IRS allows you to match up your gains and losses for any given year to determine your net capital gain or loss. If you end up with a net loss, you can use up to $3,000 per year to reduce your taxable income. Any additional losses can be carried forward into future years to offset either capital gains or another $3,000 in ordinary income. Since you don't generate capital gains or losses in a retirement account, you can't use trades in IRAs or 401k plans to offset your income in this manner. Now, I'm not going to spend a lot of time on this, but just to be clear, taxes are very important to account for with every trade you make. If you're using an online service such as E-Trade, they will create 1099s for you for each trade. You will be taxed on every trade gain you take at both the state level and the federal level. Be careful when investing that you are accounting for the taxes that will be taken before counting your percent gain. Let me give you an example. Say I bought NFLX on July 4th, 2013 and sold it on July 24th, 2014. Because I held the stock for a period of time that qualified as a long-term capital gain, so I would be taxed at my specific tax bracket as a long-term capital gain for this trade. In my case, I'd qualify for the highest tax bracket, so 20% with state and federal combined. If I would have traded earlier in the year, I would have been looking at nearly twice the tax. So what does this all mean? Basically, if you decide to make a trade, you should automatically be accounting for the percent of tax you'll need to pay in calculating your total gain. So let me expand on my earlier example with NFLX. Say I bought 100 shares at $100 and sold them for $200. A little over a year later, made $100 per share on my 100 shares. In this example, I would have paid $10,000 and made $20,000. If I subtract the two from each other, I get $10,000 a gain. But now let's include our long-term capital gains tax. The $10,000 gain times 20%, which is my long-term capital gain tax rate, which equals $2,000. So I'll need to subtract the $2,000 from my $10,000 to get my gain after taxes, which we will call the actual gain. Now, there are also small variables that can play into this. Actual gain, such as trade commissions made both before and after the trade. However, for the most part, the formula for actual gain is total gain amount times original investment amount equals capital gain. Capital gain times state and federal tax percentage equals actual gain. Chapter 20. Be the boss. Congratulations, you are officially an investor. I'm very proud of you for making the commitment to succeed, and I'm excited for you to continue buying more and more company equity and growing your wealth. Unlike you, most allow the fear of loss and the difficulty of learning to stop them. But not you. You've learned what the market is, how it works, what to look for, and how to buy. If you enjoyed this course, please encourage your friends and family to sign up as well. As I said at the beginning of this course, you've probably heard a friend, someone in your family, or just people on television talk about the stock market and how there's tons of money to be made in investing in it. And most people still have no idea what the stock market is and how to get involved and start making money. You can also help change their lives and share with them the winning secrets of how to invest in the stock market and help them learn how to become rich too. As a takeaway, never forget that the market will always have its ups and downs. But there's always a winner waiting to be found, and with fierce research, patience, and calculations, you will be forever rich. Cheers to you and your endeavors, and thank you for being a part of my program. Learn how to become rich program disclaimer. The content of this website and/or course is published in the United States of America, and persons who access it agree to do so in accordance with applicable U.S. law. All opinions expressed on this website and video program are solely opinions and do not reflect the opinions of any companies or affiliates, and may have been previously disseminated on television, radio, internet, or another medium. You should not treat any opinion expressed as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. The program's opinions are based upon information we consider reliable, but this does not warrant its completeness or accuracy, and it should not be relied upon as such. We are not under any obligation to update or correct any information provided on this website. Our statements and opinions are subject to change without notice. No part of our compensation from employers are related to the specific opinions we express. Past performance is not indicative of future results. We do not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investments discussed on this website or on the program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investors or strategies mentioned on this website or on the program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this website or on the show. Before acting on information on this website or on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial investment advisor.